So can someone confirm you can see the slides? You can still see the slides?
Yes, we are seeing the slide.
Okay, that's fine. Right, so we are going to start with IAS 37, which is provisions, contingency, and contingent liabilities and contingent assets. So basically, like I've said, I'm sure you have covered standards before, and you know the structure of the standard, that the standard looks first at the objective. What is it that the standard is made to achieve? You know of the scope that looks at the limitation of the standard, or the areas that the standard is basically going to cover. You know that a standard will have key definitions that you will need to know of the key terms that will help you understand and be able to apply a particular standard. You know that the standard will have recognition criteria, and then it will have measurement. How do we measure the specifics of the standard? It will have application of the recognition and measurement rules, and then it will have disclosure. So that's basically the structure of every standard that we have already covered so far, and the few standards that we are going to cover before we can look at consolidation. Now, you may already know that maybe the main focus from an examination perspective is on recognition and the disclosure. The other components of the standard are also important, and you are going to then cover them at your own time. I've also made sure that on the notes that I gave you, the notes actually cover all the aspects of what you need to know from the standard, the objective, the scope, the definitions, recognition, measurements, as well as application and disclosure. So we are going to focus on the areas that we need to know for the purpose of the exam, considering the time that we are left with. Right now, I know we have not covered the conceptual framework, and I'm sure that will be covered when you do your public lecture. But I'm sure by now you know the definitions of what a liability is, of what an asset is, an expense, etc. So I'm going to assume that is assumed knowledge, things that you have already covered, considering the level that you are at. Right now, IAS 37 basically looks at
Zoom meeting, Baba.
Can you please, guys, mute your mics? Can you please mute your mics? Okay, thank you. Okay, so I want to first start by talking about liabilities so that you can perhaps get the perspective of what we are talking about. So you would already know that a liability is a present obligation that arises as a result of a past event from which a future outflow of benefits is expected. So basically we are saying you entered into a transaction or you entered into a contract in the past that has resulted in you having an obligation to settle a certain amount of money or a certain amount of goods, etc., depending on the terms of the liability, that you then need to settle at some point in future. So for example, perhaps you bought goods on credit 2 months ago. You agreed that you are going to settle the debt in 3 months' time. So the past event is the contract to buy the goods. And then the obligation is for you to pay the price for the goods that you already have bought. And then the future date is when the amount is expected to be paid. So that's basically a liability, a present obligation as a result of a past event from which future economic benefit is expected to outflow. Now, that's basically what a liability is. Now, a provision, on the other hand, is a form of a liability where we have an uncertain timing and an uncertain amount. So we're basically saying you entered into an obligating event, or in the past you entered into a transaction, but the transaction that you entered into results in you being required to settle or to pay a certain amount of money. but that amount of money might not be exact, or you might not know how much you are going to pay at some point in future. You might not know when you are actually going to be required to settle that amount. So we've got a number of provisions that we create from liabilities. So we're going to talk about the most common ones, which are these four. The first one is environmental provision. So let's say you're a mining company and your mining activities are resulting in you maybe doing open cast mining and digging up some pits. And then maybe at the end of 5 years, you are going to abandon the mine and move on to the next mine. But because of the damage that you'll be doing to the environment, the governing authority, let's say in this instance, EMA, may require you to fill up the pits that you will have dug at the time that you are going to abandon the mine, say in 5 years. So an environmental provision means you know that the digging that you are doing now, which basically creates the liability, is going to result in you paying money in 5 years to fill up the pits that you would have dug. So you need to then set aside money that you are going to use to then fill up the pits once the 5 years are done, so that you can then satisfy the obligation you would have created at the point that you started digging. So an environmental provision means you are setting aside money today for an expense you are going to incur in 5 years to fill up the pit that you will be digging over the duration of the 5 years. That's an environmental provision. A redundancy provision is where you've got employees that you are planning to lay off. Maybe you're downsizing, or maybe you're automating some of your processes. And then you decide that in 6 months' time, we are going to lay off 10 of our employees or 20 of our employees. You are going to pay them packages, which are retirement packages that you give to those employees. You estimate the amount of money that you're going to pay them. You set that money aside so that when the 6 months come, you are then taking money from that provision and then giving it to those employees when you lay them off. That's a redundancy provision. Then a litigation provision is where maybe a client or a supplier takes you to court. The issue is still under the courts. You are not sure how it is going to pan out. So maybe you are selling, let's say you are chicken in, you sell 2 pizza to someone, that someone eats your 2 pizza and gets ill, takes you to court asking for damages because your food caused them to fall ill. You don't know whether the judge is going to judge in your favor or in the favor of the person who reported you. You don't know how much money you are going to be required to pay exactly, etc. So you may need to then set a provision now so that when the court case is finalized and you're asked to pay, you are taking the money from the provision and then paying for the litigation or for the court case. Then the most common one, which is the one that you should expect in any exam where IAS 37 is examined, is a warranty provision. So maybe you're making electrical goods, let's say you're making laptops, and you want to provide a warranty. If you buy our laptop and you face challenges within the first 1 year, you can bring the laptop and then we can replace it, or you can bring the laptop and then we can repair it. But then when the laptop comes and you need to replace it, it means the money to replace that laptop should be coming from somewhere, or the money to repair that laptop should be coming from somewhere. So you can, at the point that you manufacture those laptops and sell them, incorporate a warranty provision, which means you are setting aside a certain amount of money that is going to cater for any laptops that are going to be returned to you, or any laptops that will need to be repaired within the warranty period. So what usually happens with warranty provisions is, let's say you're manufacturing a laptop and the cost of manufacturing that laptop is $50. You want to add a profit margin of, say, $40 to make it $90. But you know that from your experience, it usually costs $10 to replace, to repair a laptop that is damaged. You can then add $10 on top of every laptop that you sell, so that you can then use that to repair any laptops that would then come back from customers because of the warranty. So you're actually incorporating the cost of repairing a laptop returned through warranty into the selling price, which means the customer will basically still pay for the repairs, but without having to pay additional amount of money because they've replaced it in the sales figure or sales value that you have charged the customer. So a warranty provision is a provision you set aside to replace or repair goods that you would have sold under a warranty. So a warranty provision and a litigation provision are the most common ones that you should then expect to be asked on when it comes to IAS 37. So basically, you would now understand that a provision is basically money that we have set aside so that we can pay for an obligation that we have already created. And so the liability is already there. We set aside the money so that we can then use it in the event that someone calls upon that provision. Right. So in terms of recognition, or how when do we recognize a provision, there are certain conditions that must be met before we can decide whether or not a provision needs to be created. So we create a provision, firstly, where an entity is an obligation, because we are saying a provision is some form of a liability, which means a provision must first satisfy the definition of a liability, which is a present obligation as a result of a past event from which cash flows are expected to flow. So we are saying an entity must have an obligation first for us to create the provision. So the obligation could be legal or it could be constructive. So I want to explain from this perspective. When you're talking about a legal obligation, we are saying you are obliged at law to settle a certain obligation or to pay a certain amount of money in the event that something happens. So for example, it could be a contract of sale, and within the contract of sale, you agree that in the event that the product you have sold to someone is defective, you are supposed to refund that person their money. So it's a contractual obligation, so you need to pay. Or if the law says in the event that you do A, B, C, D, you are expected to pay it, then it means it's a legal obligation on your part. Or any other operation of law. So for example, a law is passed after a contract of sale has already been done that it gives you the obligation to settle for some circumstances. That means could then be required to settle. That's a legal obligation. Then a constructive obligation is not something that is binding legally, but it's something that your actions as an organization is made people to believe that you are taking that obligation as binding. So for example, if you are a manufacturer of laptops and you are known that if someone's laptops fails to work within 1 year and that someone takes it to you, you'd actually repay it for free. But you have not said anything in the contract of sale to that effect, but it is known that your company repairs all laptops that would have challenges within 1 year. It means you have established a pattern of practice, so it becomes a constructive obligation. We expect you to continue with the practice that you have actually shown us that you do. Then a valid expectation is perhaps someone who is buying an electrical gadget would expect that if that gadget fails to work, you are supposed to replace or repair it for them. Even though it's not written anywhere or it's not part of law, we are saying it's an expectation that is reasonable for electrical goods to be repaired if they are not working when you purchase them. So that's a valid expectation. So we have said the first condition that must be met before we decide to recognize a provision or to create a provision is any entity must have an obligation that could either be legal or constructive. Then if that condition is satisfied, we move on to the second condition, which is probable that an outflow of benefits is required. Because if we are not expecting any money to be paid, then it ceases to be an obligation because there is no money involved, or there is no goods that are worth something that you may need to give to someone to satisfy the obligation that we talked about. So when you are saying probable, we are saying there should be a 50% chance, in fact, a more than 50% chance that you are actually going to be expected to pay. If there is a less than 50% chance, then we cannot create a provision. So it must be probable that an outflow of benefits is required, or there must be a more than 50% chance that you would actually be asked to pay. From a probability perspective, it depends on what type of obligation it is. So for example, if someone takes you to court and your lawyers tell you that the chances that you are going to be asked to pay are 70%, it means we can then say from the expert advice, it's probable that we are actually going to be asked to pay. If you're an insurance company and you actually says there's a 60% chance that you are going to be asked to pay, we can then say it's probable that you are going to be asked to pay. So we must have someone in a position of authority telling us that we are actually going to be asked to pay, and the probability is at least 50%. Then a provision is a liability, and a liability is an obligation that must be converted into monetary terms. So the third and final condition is that we must be able to have a reliable estimate of how much we are actually going to be able to, we are going to be asked to pay. So remember that a liability is a component of your statement of financial position. You need to then give a figure to the liability. So if you are not able to determine the figure, it means you are not able to create a provision. So it must be possible for you to estimate an amount that you are then going to provide for. So again, the same way that we look at the probabilities, the same way that we look at the liable estimate. If you are dealing with a litigation provision, for example, your lawyer from experience will tell you that similar cases that have been heard at the courts before has resulted in you being asked to pay $10,000, for example. It means the 10,000 becomes the reliable estimate. If you're an insurance company and you actually says similar cases, we have been asked to settle 50,000, means the 50,000 becomes the reliable estimate. So we must then be able to estimate the amount of money we are going to be paying. So if you then face a question in your exam that asks you the recognition criteria, or that asks you whether or not we should recognize a certain story as a provision, so this is the structure that you should then put down as your answer. If you are given a story about something that happened, and the question then asks you how we are going to recognize it, you are first going to talk about present obligation. You tell the examiner the facts within the case that suggests a present obligation is there, whether legal or constructive. Then you tell the examiner the probability that an outflow of benefits is going to be required. You tell the examiner whether a reliable estimate from the facts given in the case can actually be made. And then you conclude whether you think it's actually going to be a provision or not, which means the conditions must be explained, or you must tell the examiner how you feel or how you think these three conditions have been met, and we need to recognize a provision. So that's basically the recognition criteria as far as provisions are concerned. Right. Now, so let's say you have given a scenario, you have realized that a present obligation is there, and you have determined that the probability of you being asked to pay is more than 50%, and you're actually able to determine the amount that you are going to be asked to pay, you then need to create the provision in past accounting entries, which then becomes an important aspect as far as we are concerned. Right? So when you are creating a provision for the first time, what we are basically saying is, we know that in 6 months' time, we are going to be asked to pay $10,000 to an employee that we are laying off. So perhaps we have created a redundancy provision. But instead of waiting for 6 months for us to actually create an expense, we can create an expense now and a corresponding provision by debiting the expense we would have debited in 6 months' time, and then moving the funds to a provision account. So if it is perhaps a redundancy payment, we would debit the redundant expense today and then create a provision. So we are setting aside the money and putting it in the provision account. Right, then let's say the 6 months come and we are now expected to pay the 10,000. It means we are now taking the money from the provision account, which means we are going to be debiting the provision and then we are going to be crediting the bank. So if we have made the provision of 10,000 by debiting expense by 10,000 and crediting provision by 10,000, when we then pay the amount, we are going to then debit the provision by 10,000 and then crediting the bank by 10,000. So the provision account is now at zero, and then we have settled the obligation. Now, let's say we have created a redundancy provision of 10,000 today, and we want to settle this in 6 months' time. Then in 3 months' time, something happens that is resulted in us wanting to revise our provision. So maybe there's been changes in labor law that is now saying instead of paying an employee 3 years worth of salary, the law now requires you to pay 4 years worth of salary. It means we need to then increase the amount from the 10,000 to say 15,000, for example. So its subsequent period ends. Any changes to the provision that we need to make should then be incorporated into the provision account. So since we have already debited expense with 10,000 and credited provision with 10,000 and want to increase the provision to 15,000, we need to then top it up from the 10,000 that is already in the provision account to the 15,000 that we now want, which means we are going to debit expense with the additional 5,000 to make 15,000 and then credit provisions with the additional 5,000 to make it 15,000. So that's what we do at subsequent period end if we want to increase the amount. If we want to decrease the amount, so let's say, for example, the employee says, instead of me waiting for 6 months, can you just pay me my money in 4 months so that I can go and do something else? Maybe they've already settled another job, which means perhaps the amount that you are planning to then pay them becomes less than the 10,000 that you have already provided for. So if the amount is, say, now 8,000 instead of 10,000, we then need to reduce the provision figure by 2,000 to make it 8,000 by debiting provision with 2,000, crediting expense with 2,000, so that the provision now remains at 8,000. And when it comes to the end of the 4th month, we simply then debit provision with 8,000, credit the bank with 4,000, with 8,000, sorry, and then the provision account will go back to zero. So those basically are the entries around provisions, or this is how we account for provisions. You would obviously expect that if you are coming across a question that is asking these standards, you will get first a scenario where you need to determine whether we actually need to create a provision or not. And then after deciding to create a provision, you will then get the figures that you are going to then use to create the provision. And then any movements at the end of year or any cash payments made from the provision account, you should then be able to account for those transactions. So that's basically how we account for provisions. Now, I want to look at a few scenarios and see if we will be able to tackle them if you are going to come across them in an exam or maybe in an actual scenario. So the following issues relate to spike mining activities. So SPICO began operating a new mine in January 2023 under a 5-year government license, which required SPICO to landscape the area after mining ceased at an estimated cost of 100,000. So that's the first scenario. Our question is saying discuss. So we wanted to discuss recognition. So how do we recognize this transaction in our financial statements? So I need you to take a minute, think about it, so that when I tell you the answer, you'll then be able to compare with what you would have thought. So we want to determine whether there is actually an obligation. We want to determine whether it is probable that we are going to be asked to pay, and if we are able to determine a reliable estimate for this provision. Right. So let's go through it together. So we want to first determine whether there is an obligation, because this is the most important conditions to be met. If there is no obligation, it does not matter whether we are able to determine or estimate the cost, does not matter whether we feel it's probable that payment will be made. If there is no obligation, there's nothing to talk about. So Speco began operating a new mine in January 2013 under a 5-year government license, which required Speco to landscape the area after mining ceased. So we are told that this is a government license, and the license actually requires us to landscape the area after mining, which means this is a contractual obligation for us to actually landscape the area after mining. So when you are then answering this question, I would then expect that I would see a small heading that is talking about legal obligation. And then you would say that we signed a 5-year government contract that requires us to landscape the area after we have ceased mining. And so this represents a legal contract with the government that binds us to pay a specific amount of money to actually do the landscaping. In the event that we don't do the landscaping, it means we are going to be at loggerheads with the government, because we signed a contract with them that we expect us to do the landscaping, which means there is an obligation. We have established that an obligation is present. We then need to move on to whether we think it's probable that we are going to be required to pay the money or not. So obviously, because this is a contractual obligation, there is an expectation that we should landscape the area. So if the expectation is there, it means there is actually 100% probability that we are going to be expected to landscape. The moment we signed the contract and the government also signed the contract, it means the expectation was at the end of the 5 years, we are going to landscape. So there is 100% probability that we are actually going to be asked to pay for the landscaping. Then are we able to reliably estimate the amount? Okay, so we've already established, perhaps before we even started, that the landscaping is going to require an estimated cost of 100,000. So the amount is there, is already given, which means a reliable estimate of the cost is actually there. So it means we've satisfied all the 3 conditions that are required for us to recognize the provision. So we can go ahead and recognize the provision. Can you please mute your mic? Thank you. So we are then going to debit landscaping expenses by 100,000, credit provision for landscaping 100,000. Those are the accounting entries that we are going to create now. Then at the end of the 5 years, if the amount we are going to spend is exactly 100,000, we are simply going to debit the provision by 100,000, credit bank by 100,000, then we pay for the landscaping. In the event that the landscaping cost is actually less, let's say, for example, our landscaping cost is 80,000, we are going to debit provision by 100,000, and then we are going to credit the bank by 80,000, which is the actual amount of money that we are going to require to actually do the landscaping. Then the remaining 20,000, we're going to take it back to the original expense account that we debited when we created the provision. So if it was a landscaping expense that we originally debited, we are going to then credit it by 20,000 to show that the landscaping cost actually ended up being 80,000 instead of the 100,000 that we originally provided for. So that's as far as the first issue is concerned. Let's go on to the second one. During, say, 2014, as Speco mining activities caused environmental pollution on an adjoining piece of government land, there is no legislation which requires Speco Command to rectify this damage. However, Speco does not have a published environmental policy Speco does have a published environmental policy which includes assurances that it will do so. The estimated cost of the rectification is 1 million. So again, it's the same process. We need to first determine whether we have a legal obligation or not. If we have a legal obligation, sorry, we need to determine whether we have an obligation, not if we have an obligation, we need to determine whether it's a legal obligation or it's a constructive obligation. Right? So we are specifically told that there is no legislation which requires us to rectify this damage, which means there is no legal obligation. However, our own published environmental policy includes assurance that we will do so, which means we have created an expectation that we are actually going to do so, or we have created a constructive obligation that then binds us to say, if you have done it before, or if you have shown indications that you would do it, then you need to do it. So we've created a constructive obligation, right? So we have satisfied ourselves that an obligation is actually there. The second step would be determining the probability of us actually paying this amount. So since we've already damaged the adjoining piece of land, and we are known to actually make good of any damages that we make to lands that are closer to our mine, it means the probability of us actually having to pay are high, which means there's a high probability that we'll pay because we've already done damage to a land that is adjoining our mine, and we are known to do good for all the damages that we do at all of our mines. Then, do we have a reliable estimate? The estimated cost of the rectification is 1 million, which means actually have an amount we've already estimated, which is 1 million, which means all the three conditions are met. So we need to create a provision by debiting the expense by 1 million, crediting provision account by 1 million. So that's basically how we recognize this transaction. I hope it's clear enough. So if you have any questions before we proceed, you can unmute your mask and ask. Okay, so I will take your silence to mean that all is well. So let's look at another scenario. A business has been told by its lawyers that it is likely to have to pay 10,000 damages for a product that failed. The business duly set up a provision at 31 December 2017. However, the following year, the lawyers found that damages were more likely to be 50,000. So how is the provision treated in the accounts at 31 December 2017? So we are told by our lawyers that it is likely that we will be asked to pay 10,000 damages for a product that has failed. We have already set up a provision at 31 December. So the setting up of the provision is what part A of the person is asking us. What are we going to do? So we are going to debit expense by 10,000, and then we are going to credit provisions by 10,000. That's what we do at 31 December 2017. Then at 31 December 2018, we now have further information from our lawyers who are telling us that the damages are more likely going to be 50,000. Now we have already taken 10,000 and put it in the provision account. We are now told that we are likely going to pay 50,000, which means we need to top it up from the 10,000 that is already there to 50,000, which is the expectation that the lawyers are now giving us, which means we need an additional 40,000 that we need to take to the provision account, which means we are going to debit the damages expense account, and then we are going to credit provision by a further 40,000, which means our provision account will now have a balance of 50,000. So that's basically how we will treat this account. Remember, I said in the WhatsApp group that if you listen attentively in the lectures that we are going to be doing your in classes is going to be easy for you. So I'm hoping that you are listening while I'm explaining and you are taking note of everything that we are discussing, because I don't expect the questions that you are going to face, whether in an in-class or in an exam, to be significantly different from what we are already discussing. All right, so let's move on. So that's as far as provisions are concerned. So let's move on to contingencies. All right, so contingencies are different from provisions because it looks at cash flows that may or may not occur. Remember, when you're talking about provisions, we're saying we know that the obligation is there. We know that cash flow is going to go out of the business at some point in future. We just don't know when, but we know that it is definitely going to be an outflow. But when it comes to contingents, we are not very sure whether an outflow is going to be there or is not going to be there. So we do not know how much we may be asked to pay. If we don't know how much, it means we are not able to determine a reliable estimate of the amount that we may be asked to pay. We do not know if anything is ever going to flow. So we are not very sure if we are ever going to be asked to actually pay anything. So we have our contingencies could be contingent assets or they could be contingent liabilities. So let's say, for example, we have been taken to court by a customer, perhaps for late payment of a bill or perhaps for defective product that resulted in harm to employees of our customer. But there's no precedence at law. There is no case similar to our case that has been heard before. So lawyers are not able to determine or to make a reliable estimate. So we don't know how much we are likely going to pay because lawyers are not able to determine a reliable estimate. But we know that we may actually be asked to pay. So remember, we have three conditions that we must meet for us to create a provision. But if any of the three conditions are not met, it means a provision cannot be created. So for example, if we can't determine a reliable estimate, it means we are not able to create a provision. Okay, so that's an example of a contingent liability. We know that we've got an obligation. We are almost sure that we'll be asked to pay, but we are just not sure how much we are going to be asked to pay. So we cannot create a liability without an amount. So that becomes a contingent liability as opposed to a provision. A contingent asset is the other way around. Let's say we are the ones that are taking a supplier to court. So if you are the one, can you mute your masks, please? Can you mute your mics, please? Okay, let's say the situation is reversed. We are the ones who are taking a supplier to court. So if you are taking a supplier to court, it means we are the ones who are going to benefit if the court rules in our favor, and we are going to be paid by a supplier. So it then becomes a contingent asset. We are not sure how much the court is going to award us, but we know that there are chances that we are actually going to be paid. We just don't know the amount. That then becomes a contingent asset. Now, when it comes to recognition of a contingent liability or a contingent asset, the treatment, especially on probability, is going to be different. I'm going to explain on that. So a contingent liability is a possible outflow of economic benefits that does not meet criteria 2 and or criteria 3. So remember, criteria 1 is a legal obligation. That has to be met. Otherwise, it's not a contingent liability. The fact that we are saying it's a liability means there must be an obligation. So condition 1 must always be met, whether it's a provision or it's a contingent liability. Then number 2 and number 3 is the probability and the reliable estimate. So if it does not meet the probability criteria, but it means the reliable estimate criteria and it means the liability criteria, it means it becomes contingent liability. Now, when it comes to probability, you will see that I wrote a possible outflow as opposed to a probable outflow, because as long as the outflow becomes probable, it means we need to make a provision. So if it's probable, which means it's more than 50%, it means we make a provision. But if it is possible, it means the probability is 50% or lower. Now, if we have realized that it does not meet one of the 3 conditions, condition number 2 or condition number 3, we then need to just put a note in the financial statements to explain the issue to the users of the financial statement. Can you please mute your mics? Can you please mute your mics? Okay, so let's say a client has taken you to court. You know that there is an obligation because he actually sold something to this client and they actually paid you, and you actually said in the event that something bad happens with my product, you can come to me for payment. That client then decides to take you to court. You know that you have an obligation because there is a past event, which is the sale, that has created an obligation for you to settle. You know that the probability of you being asked to pay is actually high because perhaps your product is what is on the wrong side of things. So the probability perhaps is actually high, but you are not able to determine how much the court would actually ask you to pay, which means there's no reliable estimate. So it means you can't put a provision in your balance sheet because the balance sheet requires monetary amounts to be put. It then means what you need to do is to give the users of the financial statements information about that particular aspect, to say, we sold goods to a customer and those goods ended up perhaps giving damage to the customer. The customer has taken us to court. Chances that we are actually going to be asked to pay are high, but we are not able to determine how much the courts are actually going to ask us to pay, which means they are telling the users of the financial statements that you are not able to make a reliable estimate. So that's the disclosure notes that you need to put on the notes of the financial statement. You explain the issue and the reason why you are not making a provision and then putting it on the face of your statement of financial position. So for provisions, you actually put the provision on the face of the balance sheet. But for contingent liabilities, those that do not meet the criteria for provision, you write a note that you put permanence to the financial statements. So you simply disclose the contingent liability. So to summarize this, if it is a provision, which means it meets, if it is probable and you are able to make a reliable estimate and the probability is high, it means you need to provide or make a provision. But if it is only possible that outflow of economic benefit is going to happen, it means you simply need to disclose. But if it is remote, let's say, for example, so the standard does not explain what a remote and possible is. It simply explains that probable means 50% or higher. It means more than 50% actually, and possible means less than 50%. It means the remote or possible is then open to your own interpretation of the standard. But let's say, for example, there's a 5% chance that you'll be asked to pay. We can't then say 5% is possible, 49.5% is possible, because these are far extremes. So you can then justify yourself by saying anything less than 10% could be remote. If it is remote, there's no need for us to talk about something that may not happen. So if something is remote, then you need to ignore. You don't need to create a provision. You don't need to disclose anything. You just leave it as it is. But if it is possible, perhaps between 10% and 50%, it means you need to make a disclosure note. But the 10% is not a provision of the standard. It's up to you as the accountant to determine what is possible and to determine what is not. So that's as far as the contingent liability is concerned. Right, then a contingent asset is a possible asset that arises from past events whose existence will be confirmed by a certain future event. So basically saying, perhaps you have taken your supplier to court, you know that there's an obligation because they've actually sold you something. Perhaps you are able to determine the amount that you are asking for. Maybe you are saying, I paid you 10,000 to buy this, and this then ended up to be defective, so I want my 10,000 back. So you know the estimate, the reliable estimate, you want your 10,000 back. There's a legal obligation, but you don't know whether the courts are actually going to rule in your favor, which means the probability that you be reimbursed or paid back your money is lower than 50%. So it means it's possible that the money is going to come. It might be remote that the money is going to come, which means if it is possible or remote, you are not then able to create a provision. In any case, if it is a contingent asset or if it is an asset, there is no provision for an asset. It means what we can simply do is to aid that, disclose or ignore it. So if there is a more than 50% chance that you will be paid back your money, what we simply do is disclose. We cannot recognize it as an asset because remember, the prudence concept, we don't count our chicks before they are hatched. So even if we know that there's a high chance that they're going to be hatched, we wait until they become chicks before we can count them. So we cannot recognize an asset unless we are 100% sure that it's actually going to be an asset. So if the probability is more than 50%, even if the probability is 95%, we don't recognize an asset. We actually just disclose that there is a possibility that will be paid this certain amount in the event that the court rule in our case, in the case that we have against our supplier for the value of 10,000. So we are simply putting it in our notes. Then if it is less than 50% to zero, we are simply going to ignore it. So if it is possible or if it is remote, we are simply going to ignore it. That's as far as a contingent asset is concerned. All right, so this is the information that you are then required to disclose. So in the event that I give you a scenario and then I ask you to construct a disclosure note, I tell you a story that suggests that this is actually contingent asset or it's actually contingent liability, and the person is saying, can you construct a disclosure note, 10 marks? You should be able to then know what information you need to include in a disclosure note for a contingent liability or any disclosure note for a contingent asset. So for a contingent asset, it's very easy. You simply describe the nature of the transaction and an estimate of its financial effect. We entered into a contract of sale with our supplier, ABC Limited, and they sold us a motor vehicle, a brand new motor vehicle for $50,000. Then the motor vehicle ended up being defective. We tried to reason with them. They did not understand where we were coming from, so we took them to court. In the event that the court rules in our favor, we will be able to get our 50,000 back. However, we are not 100% certain that we are going to be paid this money, as there's no precedence, or the courts may rule in our favor or may rule in the plaintiff's favor. So that's basically what you write. As long as within your note, there's a description of the nature of the transaction and an estimate of the financial effect or the amount, then that becomes a sufficient disclosure note for a contingent asset. Then when it comes to a contingent liability, we will need an estimate of its financial effect. So if it is maybe a redundancy provision, we are planning to lay off some of our employees in 6 months' time in the event that a measure that we are looking at does not go ahead, which means there is uncertainty in terms of whether or not we are actually going to go ahead with it, or the amount that we're actually going to be able to pay it. So what is the estimated financial effect? We estimate that we may be required to pay 20,000, for example. You need to then disclose that. Then indications of uncertainties relating to the timing or the amount of the outflow. We are not sure when we are going to be required to pay, because perhaps it's a court case. You don't know whether it is going to be paid this year or it's going to be paid next year. So the timing is uncertain, or maybe the amount is not exactly, it's not something that you perhaps can estimate from the information that is available. Or perhaps there's a possibility of any reimbursement, you need to disclose it if there is one. For example, if it is a court case, you say, we are waiting for a court date with the High Court. In the event that the High Court rules against us, we are planning to take or to make an appeal with the Supreme Court. In the event that the Supreme Court rules in our favor, we are going to be reimbursed maybe 70% of the amount, etc. So specify the estimate, specify the fact that it's actually uncertain timing or uncertain amount, and if there is a possibility that you may be reimbursed after you have already settled the obligation. So those are the requirements as far as disclosure is concerned. All right, so I'm going to give you these slides. And when I give you these slides, they will have questions that I want you to take a look at. I will not include answers for some of the questions. So it's up to you to then research and try to find answers for the questions that would not have answers. In case you meet them somewhere else, and then you regret why you didn't look at them when I told you to do so. So let's do this one together. Warren Tea Limited is a manufacturer of golf tees. Tees purchased are covered by a 3-year warranty, whereby the company will replace any defective tees. At the end of last year, on 31 March 2016, a provision of 150,000 was made. During this year, 75,000 was paid for the cost of replacing tees under warranty. And at the end of this year, the company estimated that a provision of 135,000 was needed. You are required to show all the accounting entries and disclosures that are required for this transaction. So this is the information that we have. At the end of last year, which is 31 March 2016, we already created a provision of 150,000. Then during this year, 75,000 was paid for the cost of replacing the tees. So if you are required to show all the accounting entries and disclosures, it means from the one that you made last year, which is 31 March 2016. So we would know that when we are creating a provision, we will first debit expense 150,000, credit provision 150,000. So this was the entry that was made at 31 March 2016. Then during this year, we then took 75,000 from the 150,000 and paid for the replacement of some tees that were under warranty, which means we went on and debited the provision by 75,000 and credited bank because we're actually paying money, which means the balance that was left in the provision account was 150,000 that was there minus the 75,000 that we paid, which means the provision account now had 75,000. Then at the end of this particular year, we then estimated that the provision was now going to be 135,000. So when we are creating a provision, especially for, can you please mute your mics? Okay, so when we create a provision, this is what we do. So let's say, for example, we are making sales of golf tees, like in this question. We make a provision based on the quantity that we have sold, which means if our provision is 10% of the sales amount, if the sales amount is $100, it means for one tee, we make a provision of $10. For 100 tees, we make a provision of 1,000. So the provision will then go up and down depending on the number of units we would have sold. That's why perhaps at the end of 31 March 2016, the provision was 150,000, but at the end of 2017, the provision was 135,000. It means we sold less tees in 2017 than the ones that we sold in 2016. That's why our provision is actually going down. Now, if we had not paid the 75,000, it means we are simply going to reduce our provision from 150 to 135 by debiting provision with 15,000 and crediting expense by 15,000. But the case is we actually took 75,000 from the provision, which means there was 75,000 left in the provision account. Now, at the end of the year, we need to then increase it from the 75,000 that is left to the 135,000 that we now need, which means we are simply saying 135 minus 75, which should be 60,000. So we are basically then debiting expense account by 60,000 and then crediting provision by 60,000 so that it increases to 135,000, which is the new provision amount that we require. So those basically are the three entries that are required. The entry to create 150 provision, the entry to make payment for the 75,000 for the cost of placing the T's, and then the entry to increase the provision to the new value of 135,000. Right, then in terms of the disclosure notes, you are now then explaining the fact that you had created a provision for the cost of replacing T's of 150,000. During the year, we made payments of 75,000 towards the cost of replacing the T's that were under warrant. At the end of the current year, we then estimated the provision that we needed to 135,000, which is the reason why we then made an additional entry to the provision account of 60,000 so that we can increase our provision from 75,000 to 135,000. You can actually put a table that explains this for the benefit of the users of the financial statement. So this is an example of how we can then create a disclosure note that explains this scenario. So note number X, talking about provisions, we state what the provision was at the beginning of the year. It was 150. We specify the amount that we used during the year to pay for the cost of replacing the T's, which is 75,000. And then we incorporated the bump up of the provision or the increase of the provision by 60,000, such that the provision at the end of the current year becomes 135,000. Then we explain that the warrant provision relates to the estimated claims on those products sold in the year ended 31 March, which come with a 3-year warranty, and the expected value method is used to provide a best estimate. It is expected that the expenditure will be incurred in the next 3 years. So the concept of the determination itself of the liable estimate, we are not going to cover it. We are going to simply focus our learning on the recognition, measurement, and disclosure without going deeper into the technicalities of how we determine the provision in the first place. So don't worry about the expected value method that is mentioned there. Then the table above is essentially a tier account. You are not going to be putting this tier account. This is simply for illustration. So your disclosure note starts from where it's written, not X, the provision, up to the paragraph where you're explaining what the provision is all about. Then that's basically it. So this tier account is basically just you're not put in a tier account format. So that's basically how we then disclose a provision in the notes to financial statements. All right, so we want to move quickly to onerous contracts, which is a form of provision that is important as far as the standard is concerned. In fact, the standard actually mentioned onerous contracts and there's a number of pages basically explaining what onerous contracts are. But basically, onerous contracts are contracts where the cost of discharging the contract is greater than the benefit that accrues under it. So let's say, for example, you are renting premises, and on the premises you are selling goods, and you are then using the money that you make from selling the goods to pay rentals on the property that you are actually renting. Now, there may come a time where you feel that business is not going on well, such that the amount that you are actually going to be getting from selling the goods may not actually be enough to pay the rental fee that you are required to pay every month. So that's basically what an onerous contract is. The cost of discharging the contract is greater than the benefit that accrues under it. The money we are getting from actually selling goods at that particular premise is actually less than the rental that we need to pay for the premises that we are actually renting. So if you are faced with a situation where you've realized that I am in an onerous contract or a contract where I need to pay more than what I'm actually getting, you may need to then create a provision. And the provision that is required is the cheapest option of exiting the contract, which is the lower of the cost of fulfilling the contract or any compensation or penalties payable for failing to fulfill it. Let's say, in the example that I've given, you have a lease contract for the next 3 years, but you are feeling that I'm actually paying more than what I'm actually getting as revenue. Then you need to then say, if I stop selling goods at this particular premises, how much rentals am I going to be paying over the remaining period or the remaining tenure of the lease? So let's say, for argument's sake, the rental payments that are left 100,000. Then you consider, if I were to cancel the lease today, are there any penalties that I'm going to be asked to pay for canceling the lease? Maybe the penalties are 80,000. So we are saying you create a provision that is the cheapest option of exiting the contracts, which is the lower of the cost of fulfilling the contract, which is the 100,000 rentals that you need to pay until the contract lapses, or any compensation or penalties payable for failing to fulfill, which is the 80,000 you need to pay for terminating the contract. So you take the lower of the two. If terminating the contract is cheaper, you make a provision for the amount that you need to pay for terminating the contract. If paying the rentals is cheaper, then you make a provision of the rental amounts that you're going to pay if you continue to pay the rentals. So that's basically the lower of the two. That's the provision you need to create. So for example, ABC has 10 years left. A sales contract that has recently seen a cost spiral. The present value of the cost to be incurred on completion of the contract estimated is at the reporting date is 50,000. The cost of terminating the contract early is 55,000. So we are saying if you complete the contract or if you continue paying the contractual terms, you pay 50,000. But if you were to terminate, the penalty for terminating contracts 55,000. How should the above scenario be accounted for? So it means we are going to look at the two amounts and consider which one is the lower of the two. So obviously the lower of the two is 50,000. Then it means we need to create a provision for this onerous contract of 50,000. So we are going to set aside 50,000 so that we can then just pay the 50,000, since we've realized it's actually cheaper than trying to terminate the contract now. So the accounting entries are the same. We're debiting expense. And so if these are rentals, you're saying rental expense, you debit it 50,000. And then you're going to credit provision for an onerous contract with 50,000. And then when it comes time to pay, you are simply debiting the provision and you are crediting bank. So that's basically as far as onerous contracts are concerned. So for our intents and purposes, and with regards to our course outline, this is basically what we need to know. We need to know about provisions, the conditions that would make it possible for us to create the provision, how we then attempt questions with regards to the three conditions that needs to be met, disclosure notes for contingent liabilities, disclosure notes for contingent assets, accounting entries and disclosure for onerous contracts. That's basically what we are required to know. Right, then, so to wrap up this standard, why is this standard necessary in financial reporting? So we know of the prudence concept, which we can basically summarize the analogy. We must not count our chicks before they hatch. It's better to understate our income than to overstate it, or it's better to overstate our expense than to understate it. So prudence requires foreseen losses to be recognized. If there's a chance that we're going to be asked to pay some money in some future because of things that we have already done, which is past events, we would rather provide for that expense now. In the event that that expense does not then happen, we are still better off because we can write it off from liability back to the expense account from which it came from. So the objective of the standard is to ensure that provisions are recognized and measured consistently. If we are manufacturing things that require us to make a warrant provision, we must make sure that we recognize that warrant provision and we must do it every year in a similar manner. Then sufficient information is disclosed to understand the profession. Because remember, I think Pamagaita IAS 1, you understood the fact that we are preparing financial statements for the benefit of users who are the stakeholders of the business. They need information to make decisions, whether they are shareholders, they are lenders, they are potential buyers, they are the government. They need proper information to make decisions. So if there are issues that are happening there in the courts, they need to know about it, which means you need to give them sufficient information in the disclosure notes so that they know what is happening. If there are chances that we are going to be asked to pay a certain amount of money in future, we need to make provision now so that they at least get the picture of what is coming in the future. So that's basically why this standard is important. So that's as far as our provisions and contingencies are concerned. So if there's anyone with a question with regards to this specific standard, you can unmute your mask and your mic, sorry, and ask your question. Or you can just say something so that I know that you're listening. Is anyone there? Did you just join the meeting and went away? Who is Edward? Is Edward there? Edward is a ghost. Gracious. Hello? Gracious, did you say something?
We are listening, sir.
You're listening?
Say we were listening.
You're listening. Do you have any questions?
We were.
Sorry?
Yes. Yes. I said we were listening. Say we were present.
Were you understanding though?
Not really, no.
Not really.
Yes. It was clear.
Okay. Anyone else? Okay, so I think we can move on to the next standard. Right, the next standard that we want to look at is events after reporting period. And so this is a fairly small standard. But that would have a lot of questions and a lot of application issues when you then come to industry, which means you need to understand it well. So basically, when we are talking about IS10, which is events after reporting period, its purpose is to define which events should be recognized in our financial statements. So events after reporting period, we are saying, let's say, for example, our year begins on 1 January and ends at 31 December. So let's say we are looking at 2022. So our year is, or our accounting period, 1 January 2022 to 31 December 2022. That's the accounting period. Then a company would obviously need time. You can't say on the 31st of December 2022, you've already produced your set of financial statements and then you are already publishing it for the benefit of your stakeholders. You are first going to need time to make sure that your trial balance is balancing. So companies would usually need a month or 2 months or even 3 months, depending on the size of the company, to come up with a balancing trial balance and then be able to prepare financial statements. So let's say, for argument's sake, we are a medium-sized company and we believe that by 28 February, our trial balance will be ready for our auditors to prepare a set of financial statements on our behalf if we are doing compilation with them. So we do all the necessary work, and 28 February, the financial statements are done. Then once the financial statements are done, they will need to be approved by the board first, because it's the responsibility of the board to prepare financial statements. So let's say, for argument's sake, we get approval from the board of directors on 30 March 2023 for the 2022 financial statements. Once we get approval from the board, we then take those financial statements, the shareholders, if you are listed company, the shareholders then accept and adopt the financial statements, maybe on 30 April 2023. So we are saying, we're not talking about events after reporting period. We are looking at things or information that we get between 31 December, which is our year end, to 30 April, which is the date the financial statements are authorized by shareholders for issue to the public. So those events that occur between the end of the reporting period and the date when the statements are authorized, those transactions or those events are what we are calling events after reporting period. So you don't have to worry about the other timelines that I talked about or the other ones that you talk about. I'm sure you would cover that when you look at your audit and assurance module. So from the time that the year ends to the time that the financial statements are made public, there are events that are going to come to light. So we want to then determine how we are going to deal with those events by first categorizing them into two categories: adjusting events and non-adjusting events. So adjusting events are events that provide evidence of conditions that existed at the end of the reporting period. We are saying we get information on 5 January about things that happened as far back as November. So if they happened in November, but we then come to know about it in January, even though we came to know about it on 5 January after the year already ended, we will need to go back and change the figure, because these events are talking about things that happened before the year ended. That's why we are calling them adjusting events. It means we should go back to the financial statements and change the amounts that are affected by the event that came to light. So let's say, for example, in one of our factory, stock was stolen. The stock is worth 50,000, but our total inventory is worth 200,000. So at the end of the year, we report 200,000 as our stock. And then 10 January, we then find information that suggests that our stock was stolen, which was worth 50,000 sometime in December before the year ended. So it means we must go back to the inventory figure and change it from 200,000 to 150 to reflect the fact that the stock worth 50,000 that is not there because it was stolen. So it means we go back and adjust, because even though we came to know about this after reporting period, this condition actually existed before the year ended. That's adjusting events. The non-adjusting events are events that are indicative of conditions that arose after the reporting period, which means we are getting information about things, but these things actually happened after the end of the year. Right. So let's say, for example, one of our warehouses catches fire on 5 January. Our year end is 31 December. We estimate that the value of the stock that was destroyed by fire is 50,000. But at the end of year, we reported our inventory as 200,000. We don't need to go back and adjust the figure, because as of 31 December, the stock was still there. It was destroyed after the year end, which means we are not going to go to the financial statements and adjust anything. But if the value of the stock was significant enough, we may need to disclose or to tell users of the financial statements that of the 150,000 stock that we are reporting in our financial statements, 50,000 of it is no longer there because it was destroyed by fire, which means we are simply disclosing it, but we are not going to be adjusting the fee. So that's basically non-adjusting events. Now we can then take the non-adjusting events further to determine whether or not it is going to impact on going concern. Right? You would remember from when you did your IAS 1 that there are two ways that we can report financial statements. We can prepare financial statements on a going concern basis, which means we are saying we believe that our business is going to be in existence for the foreseeable future, or we are not expecting that next year or the year after we are going to be closing our business. That's preparing our financial statements on a going concern basis. But if we believe that our business is being negatively affected by certain conditions such that we may not be able to operate in the following year, it means we need to then prepare them on a break-up basis. I'm sure you already have covered this under AS1. So if events come to light after the reporting period, that suggests that the company is no longer able to operate into the foreseeable future. It means the basis upon which we prepared at 31 December, which is the going concern, is no longer valid because of the circumstances that we now know, which means we need to then change from a going concern basis to a break-up basis. Right? So that's if the conditions are severe. So for example, if we've got one branch, if that branch catches fire and we don't have insurance, it means we may not even be able to continue operating because we don't have premises, we don't have stock, we don't have assets anymore, which means we are now preparing our financial statements on a breakup basis. So that's basically how we look at events after reporting period. Now, if you get a scenario in an exam, the first thing you need to determine is it an adjusting event or a non-adjusting event? To determine that, you look at the scenario and ask yourself, is it telling me about conditions that existed at the end of the year, or is telling me about conditions that arose after the reporting period? If it's telling you information about things that had happened before year end, it means you need to go back and adjust your financial statements. But if it's telling you about things that then happened after year end, it means you don't have to adjust anything. But you need to then ask yourself whether you feel it's going to affect the going concern basis upon which you prepared your financial statements or not. If it impacts on going concern, you use the breakup basis to prepare your financial statements. If it does not, then you don't need to adjust financial statements. You simply need to disclose in your notes to the financial statements. So that's basically events after reporting period. So I want to look at a few examples of what events would be categorized as adjusting and which events would be categorized as non-adjusting. All right, so let's start with adjusting events. If you get information that suggests that one of your customers is insolvent or bankrupt, it means they no longer have money. So chances of them actually paying you back your money are now slim. But you would realize the fact that someone does not become bankrupt overnight. So it means if you realize on 5 January that one of your customers has lost their business, they are no longer able to pay you your money, and they don't have any assets to talk about that you can take and use as a fallback position, it means that particular customer is now insolvent. But you would then believe that this may actually have happened over a certain period of time, or 6 months ago, they actually knew that they didn't have money anymore. They just didn't tell you about it. So if you realize that a customer is now insolvent, Muswa 5 January, you would then believe that perhaps they knew about it before the end of the year, or they were insolvent before the year even ended. So let's say they owed you 50,000 and you now know that they're insolvent, and your total receivables figure was 500,000. You would then have to go back to your receivables figure and remove the 50,000, because you know that amount is definitely not going to be coming to you, which means it's basically an irrecoverable debt. So you go back to your financial statements and you reduce your receivables figure by 50,000 to make it 450,000, to reflect that the fact that one of the debtors were actually insolvent before the end of the year. You simply knew about it after the year it ended. Then when you did your IAS2 inventories, you would remember that we value closing inventory at the lower of cost or net realizable value. Cost is easy to ascertain because we simply determine how much we paid for the inventory to be in its current state and its current location for you to be able to sell it. So they've incorporated all of the costs and then determine this cost of my inventory. But there are certain circumstances where we may be forced to sell goods at lower than cost. Perhaps they are going to expire soon and you want to get them out of the way, or they're becoming obsolete, etc. So net realizable values, be able to actually determine it after selling, to say how much did I end up getting from selling these inventories. So let's say, for example, you had stock worth 50,000 as a 31 December. And then on 5 January of the following year, you are only able to get 45,000 from selling that stock. Right? So that then means your net realizable value is 45,000. But at the end of year, you considered cost only because you did not have net realizable value, which you then got after realizing or after selling the goods. It means you need to go back to your inventory and adjust it by 5,000 to 45,000 to reflect the lower of the two, which is the net realizable value of 45,000. So if you sell goods at less than the cost after the end of the year, you need to adjust to reflect the value as the lower of cost and net realizable value. Then the next scenario is where you discover a fraud or error. We actually talked about an example similar to this. If you realize that someone stole money and you didn't know about it, but then you realize that the money was stolen after year end, maybe you didn't do cash counts on 31 December, you then do your cash counts on 10 January when you reopen, and you realize the money that you thought was 100,000 is actually 80,000, 20,000 was stolen. It means you need to then go back to your cash balance in the statement of financial position and change it to 80,000 to reflect that fraud that occurred before year end and was discovered after year end actually occurred in December or in November, etc. So you simply go there and you adjust. Or you realize that instead of 10,000, you wrote 100,000 and then you overstated your cash balance, for example. It means you made an error but discovered it after year end. You simply go back and adjust the amount. All right. Then a settlement of an unresolved claims. I think we talked about a similar transaction from a provisions perspective, to say you made a provision at the end of the year, maybe 31 December 2022, of a litigation issue, but you didn't really know how much you were going to be asked to pay exactly. and then maybe the case is finalized 20 January of the following year before you actually publish your financial statements for external stakeholders. You had made a provision, say, of 100,000, the court then you rule and say you must pay 70,000. It means 70,000 becomes the actual expense that you pay instead of the 100,000 you had provided for. And remember, when you provide for it, you give debited expense and credited provision by 100,000. It means you need to then go back and account for the 30,000, or reduce the expense component by 30,000 after the settlement is resolved. All right, then impairment of assets. I am not sure whether you've actually covered impairment of assets yet. But basically, we are saying if the value you have reported your asset in the financial statement, which is your carrying amount, has become higher than the recoverable amount. So let's say you've got a motor vehicle, the carrying amount, which means your cost less all the depreciation you've charged so far. Let's say you bought it for 10,000. You have depreciated it by 3,000, which means on the balance sheet, you have reported that your motor vehicle is worth 7,000. But if you had to go to the market and say, I want to sell this motor vehicle today, you realize that you would actually be able to just get 5,000 instead of 7,000. It means the asset is impaired because it's a recoverable amount, or the amount you can get from actually selling it is less than the value you have reported on your balance sheet. Remember prudence. So it means you need to write down the value of the assets to 5,000, which is the release amount, not the 7,000, which is the carrying amount. So the difference between the two, which is the 2,000, is the impairment expense. So impairment expense or impairment generally, you can only be able to get it after determining the recoverable amount. So if you determine recoverable amount after year end, it means you simply go back and adjust the amount so that it shows the recoverable amount if it is lower than the carrying amount of the asset. But I'm sure if you've covered the impairment of assets, you are familiar with this. So those are some of the events that can be categorized as adjusting events from this standards perspective. The non-adjusting events, those events that we say happened after year end, could be issue of shares. So if you issue new shares in January, you don't need to go back to December and adjust the amount because these new shares were not there as a 31 December. But what you may need to do is to disclose, because those that are making decisions on the financial statements you have presented. So now if you have issued new shares, you have the responsibility to notify those users that after the year end, we decided to issue new shares. So the share capital that we are seeing on the balance sheet is not actually the share capital as we are speaking, because we issued new shares and the share capital has increased. But we are not going to adjust the financial statements because as the 31 December, these shares were not yet there. If you dispose or purchase of any key assets, you may also need to disclose it. So for example, if you have 100 delivery motor vehicles and you sell one, you may not need to talk about it because it's not significant. If you've got 100 motor vehicles and if you sell 50, it might be important information for users of financial statements to know that you have sold 50 motor vehicles because it's significant to the decision that they are making. It means half of the assets you have retained motor vehicles is actually no longer there. So they may need to know that information before they make decisions on whether they want perhaps to invest in you or not. Then declaration of dividends, you have declared dividends that you are planning to pay perhaps at some point in time in the current year, but you would know that the dividends are based on profits you would have made in the previous year. So any declaration of dividends would need to be disclosed, but it's not going to change anything because you simply just declared them, you have not paid the dividends yet. Then if there's any destruction by fire of your warehouse, of your key assets, you may need to also just disclose that there was a fire that damaged the part of the stock that we are seeing retained in our balance sheet. Or if there are any litigations or any court cases against you that were instituted after the year end, you may need to give information to users of financial statement as a cautionary statement to say, we have been taken to court by clients, so this is what they are asking from us as a result of these transactions that happened. We believe that there's a 60% chance that we may be required to pay etc. That disclosure that we talked about under provisions is basically what you need to put as a non-adjusting event. So the list is endless. These are just examples of what you would ordinarily find in a question, or maybe even in real life scenarios. These are the most common kinds of adjusting and non-adjusting events that you need to look out for. All right, so you should expect a lot of multiple choice questions to come from this standard, and a few perhaps questions that come as part of a longer type question. I'm sure you now you have access to past exam papers. You see how the exam is set and the kind of questions that you should expect, including preparing consolidated financial statements with the notes that speak to changes that need to do to the figures in the financial statements with regards to application of the standards that would have covered. So, for example, you could get a question that requires you to consolidate financial statements, and then there's an inventory item there, and then you are told that part of the inventory was destroyed by fire. Then you would know that you don't need to go and change the figure before consolidating, because if it was destroyed after year end, it becomes a non-adjusting event. So that's basically how you apply it if it is not a multiple choice question. Right, let's look at a scenario together. So each of the following events occurred after the reporting date on 31 March 2015, but before the financial statements were authorized for issue on 15 July 2015. Which of the following adjusting events after, which of the following are adjusting events after the reporting period? So our year end, instead of 31 December, in this case, is 31 March 2015. And then our date of issue of financial statements to the public is 15 July. So there are things that happened between 31 March and 15 July. You are asked which of them are adjusting events. So remember, adjusting events are events that tell us more information about conditions that existed before the year end. So a dividend of 5 cents per ordinary share was paid on the 1st of June 2015. Now, we paid this dividend after 31 December, which means this is not something that existed before year end. It's something that actually happened after year end, which means we simply need to disclose that we actually then declared and paid dividends of 5 cents per share after the year end. So A is not part of the answers. A credit customer with a balance outstanding at 31 March was declared insolvent on 1 May. So we said a person cannot become insolvent overnight, which means these problems existed in this customer's company for some time before it was made public. So we are saying since his debt was outstanding at 31 March, the fact that he was declared insolvent on 1 May does not matter. It means by 31 March, probably that customer was already insolvent, which means we need to go back to our financial statements and reduce our receivables by the amount estimated or the amount that we owed by this customer that became insolvent. Then a flood on the 10th of May 2015 that destroyed a small quantity of inventory that cost 2,000. So again, the flood happened on 10 May, which means by 31 March, the goods were still there. So as far as we are concerned, we are not going to go back and adjust anything. We are going to leave it as it is. And then we are actually told that it destroyed a small quantity of inventory that cost 2,000. So the fact that it's small quantity means we may not need to even talk about it or disclose it because of the amount that is involved. So perhaps if our total inventory was 5 million and inventory worth 2,000 was destroyed, we don't need to shout about it. So it means we don't need to do anything as far as this transaction is concerned, considering that it's not an adjusting event. 1, 2, the amount is low, and we don't need to waste space in our financial statements by disclosing it. An inventory valued at cost of 700 at 31 March was sold for 610 on the 3rd of April. So we said at 31 March, we were actually supposed to have valued our stock at the lower of cost or net realizable value. We just didn't know what the net realizable value of those goods was as the 31 March because we had not actually realized anything from selling them. We then realized 610 when we sold the goods on the 3rd of April, which then means the realizable amount was lower than the cost, which means it's the amount we're supposed to have reported as our inventory. So it means we need to go and adjust our inventory by crediting inventory with $90. That is a reflection of the reduction in the amount due to the cost being higher than the net realizable value, and then we expense the other leg. So that's basically the thought process when you're answering these multiple choice questions. Right, so again, I've put some more questions for you to look at and research on them. Maybe let's look at this together. The following material events take place after the reporting date of 31 December 2021 and before the financial statements of Tapenet Company are approved. The question is, what is the effect on profit for the year in the financial statements at 31 December 2021 of making the required adjustments? Okay, so the first thing that we need to determine from these two scenarios is, do we actually need to do any adjustments or not? And we determine that by first categorizing each of them as either an adjusting event or a non-adjusting event. So the first event, Barrels Company, a major customer of Tapenet, went into liquidation. Tapenet Company has been advised that it is highly unlikely to receive any of the outstanding debt of 150,000 owed by Barrels at the year end. So we said, if you realize that a company or a customer is facing financial challenges or is getting into liquidation, it means it did not happen over time. They were always, or by the end of the year, they were actually bankrupt. We just didn't know about it, which means we need to go back and then debit irrecoverable debts by 150,000 and credit our receivables by 150,000. Our question is talking about the effect on profit, which means between the two legs of the transaction, what affects profit is actually the irrecoverable debts of 150,000, which means our profit is going to be reduced by 150,000. That's the first part. The second part is saying a fire occurred in the warehouse of Tapenet Company and the stock costing 75,000 was destroyed. Now, a fire occurred after the year end because we were told that these two happened after the year end. But by the end of the year, this stock was still there, which means you don't need to go and change anything, but we simply need to go and disclose that 75,000 of the stock that we had was actually destroyed by fire. So this is an example of a non-adjusting event, which means the only amount that affects our profit is the 150,000. So our answer becomes a reduction of 150,000. So basically, that's how we tackle questions regarding the application of this standard. Okay, so like I said, this is a fairly small standard. So as long as you know, in summary, how to categorize events after reporting period, are they adjusting or non-adjusting, then you will be fine. If they are adjusting, if they are non-adjusting, do they affect the going concern basis or not? If they affect the going concern basis, we use breakup analysis. If they don't, then we simply disclose them. Right, so that's as far as this specific standard is concerned. Right, so we want to move on to the next standard that we want to discuss today. So this will be our last standard for today. Then we can pick it up on Monday when we are going to be looking at upstream accounting. Right, so we want to look at another fairly short standard, which is accounting policies, estimates, and errors. Right, so let's look at IS 8, which is accounting policies, estimates, and errors. Right, so basically, so at the end of the module, I'm going to share with you examples of a full set of financial statements prepared by actual companies registered on the stock exchange, so that you can have a feel of what financial statements would actually have. But based on your understanding of IAS 1, you would already know the components of the statements of financial statements that would have our statement of financial position, statement of comprehensive income, statement of changes in equity, and statement of cash flows. Then over and above that, we have a section that talks about accounting policies, and then we have a section that talks about accounting notes or notes to the financial statements. So accounting policies are very important for you to explain, because these are perhaps the ways that you treat certain issues that are not governed by international financial reporting standards. So users of financial statements would obviously want to know about them, because they know you have not applied international financial standards in determining how you are going to treat certain issues. So these are specific rules or specific principles that are applied by companies in preparing their financial statements, and taking into consideration that every company decides its own accounting policy. So if you're holding two sets of financial statements, you may realize that the accounting policies are totally different. So the most common examples of accounting policies are, for example, capitalization. So for example, if you buy a motor vehicle as a company, you may not have much of a choice in determining how to treat it, because you know that a motor vehicle is a non-current asset and it must be capitalized. So that's basically, so that's the capitalization of a motor vehicle. But let's say, for example, you buy a stapler and you want to determine whether you should actually treat that stapler, the amount you paid for the stapler, as an expense or perhaps as an asset. So one person can argue that a stapler's value is very small. So if I'm Delta Beverages and I am treating staplers as assets, it means I would have a very long asset register of things that are not basically adding much value. Then some other companies would want you to treat a stapler as an asset. So perhaps maybe you don't have any motor vehicles, the biggest asset that you have is worth $100. And for you, you are considering that a stapler is going to be used for the next 1 year. So it actually meets the definition of an asset. So you need to then determine your capitalization levels. And say, for argument's sake, if I buy anything that I'm going to be using in the business as an asset, and it costs $10,000 or less, I'm going to simply treat it as an expense. But if it costs more than 10,000, I'm going to treat it as an asset. So that's your capitalization policy. So it differs from one company to the next. Yes. Then depreciation, on the other hand, is also an accounting policy that you need to decide. So giving the same example that I gave, you may want to decide whether you want to depreciate your staplers or not, or you want to depreciate your property, plant, and equipment or not. So some companies may decide that we are not going to be depreciating any office furniture. We are simply going to write it off as an expense, for example. Then another company may decide that we wanted to depreciate furniture, for example. I'm sure when you looked at IAS 16, you discussed the concept of depreciation, and that if we are to decide that we don't want to depreciate desks, it means all the assets within the class to which desks belong to will they need to follow the same strategy or the same policy. So we're determining our depreciation policies, which classes of assets do we need to depreciate, and which classes of assets do we need not to depreciate. We are not talking about useful lives. We are not talking about depreciation percentages. We are talking about whether or not we should depreciate a certain class of assets. That's the policy. When you are talking about depreciation charge useful life, we're now talking about estimates. It's no longer policies. It's important that you understand the distinction between an accounting policy from a depreciation perspective and an accounting estimate from a depreciation perspective. Deciding whether or not to depreciate is the accounting policy. Deciding which percentage to use becomes the accounting estimate. Same applies with the revaluation. Deciding whether or not we should revalue our asset. Remember, your depreciation could be on a cost basis or on a revaluation basis. Deciding that means it's an accounting policy. Which classes of assets are we going to revalue? For example, most companies will revalue property, plant, and equipment, but will then decide to use the cost basis when they are depreciating perhaps fixtures and fittings, your office furniture, your motor vehicles, etc. Right, then classification of costs. I think we've already talked about it on capitalization to say, how are you going to be classifying your costs? Are you going to classify them as expenses, or are you going to classify them as assets? That is an accounting policy. Right, so any change that you do in accounting policy must be applied retrospectively. So you do already know from your IS1 that when you prepare financial statements, we prepare them for the current year and the previous year, because we want the users of financial statements to be able to compare the performance of your company in the current year and in the year before. So we are preparing a set of financial statements with 2 years every time we are producing a set of financial statements. Now, if in the current year you've decided that you want to depreciate assets, but in the previous year you had not depreciated assets, let's say you did not buy any new assets in the current year, you did not sell any new assets in the current year, your asset value was 100,000 in the previous year, then this year you decided to depreciate assets and your depreciation charge is 10,000. It means your assets are now 90,000 this year and 100,000 last year, but they are the same assets, right? So you will then send the wrong impression to the market that you actually perhaps sold some of your assets because your asset value is decreased. Yet you depreciated your assets this year and did not depreciate for last year. So if you then decide to adopt the depreciation this year, it means you must also depreciate the last year so that you can compare like with like. So that's the retrospective change. If you decide starting 2023, we are going to depreciate our assets, it means you need to go back to 2022 and also depreciate them so that you can be, your financial statements can be comparable, which is a key quality that is required in a set of financial statements. Then, when you change an accounting policy, you need to restate opening balance. All right, so for example, if you charge depreciation in the current year, but you did not charge depreciation in the previous year. We said for comparability purposes, we need to apply it retrospective. But you would remember that the depreciation reduces profit, and the profit is a component of retained earnings, which means in your statement of changes in equity in the previous period, you would not have taken into consideration depreciation in your retained earnings, which is a collection of all the profits that you had made in the previous years, which means you need to then do a prior adjustment of your retained earnings to reflect depreciation you would have charged last year if you had started applying that policy in the previous year. So it means we need to restate opening balances and the prior year adjustments that would need to be done in the statement of changes in equity. Again, we are going to try to find a question that we can use to apply this without actually going back to IS1, which I've already covered in the previous module. So when we do one of the questions that we're going to do when we are discussing consolidation, we're going to make sure that one of the notes would require us to do a prior adjustment in the statement of changes in equity. Right. So then once you have chosen a policy, you must then apply it consistently. If you have decided that I'm going to depreciate my motor vehicles, it means you need to depreciate motor vehicles consistently every year from the point that you decide into the future. All right. So again, consistency makes it easy for comparability, which is a key quality of good financial statements. You should be able to compare this year with the previous year or 5 years. So that is why it's accounting policy. Then accounting estimates are a judgment required in the application of the accounting policies that we have to. So let's say, for example, your accounting policy is that you depreciate motor vehicles every year. But how are you going to depreciate it? What is going to be the useful life of those motor vehicles? What is the percentage rate of depreciation that you are going to be using? That then becomes the accounting estimate. The decision to depreciate is the policy. How to depreciate is the accounting estimate. Accounting policy, we are going to reduce the value of our receivables to reflect the possibility that we may not be able to recover all of our money from our customers. So how are you going to calculate or to reduce the amount of receivables? I'm going to generate an allowance for receivables of 5% of my total receivables. That becomes the accounting estimate. Right. Warrant obligations, I think we've already talked about warrant obligations. We are saying there are chances that some of our goods are going to be retained and may need to be replaced. So I need to set aside 10% of the selling amount per unit as a warrant provision. That's in estimate because we are putting an amount to it. Inventory obsolescence, again, which of your inventory is now below cost, or which of your inventory are you no longer able to sell, and how are you going to write it off? As long as you put an amount to it, it becomes an estimate. So whenever you change an estimate, you apply it prospectively. So let's say, for example, your original decision was I'm going to depreciate my motor vehicles 25% per annum. Then you decided to change it to 20%. It means you don't have to go to previous year to change it to 20%. You simply start here, this year, and then apply it in the following years consistently. So you apply it prospectively going forward, as opposed to retrospectively going back, which is what we discussed on accounting policies. So any change in accounting estimates then basically affects current and future periods. It does not affect any periods before. So that's basically accounting estimates. The distinction between the two is very key. Make sure that you understand it and you are actually able to explain it. Right, then the last aspect touched by this standard is accounting errors. So if material errors discovered will be dealt in the same way as policy changes. If you discover that you made errors, but not every area. Areas that you feel are material enough. So, for example, if you have revenue of $10 million and you make an error of $10,000, you may not necessarily need to worry yourself about 10,000 when you have a 10 million revenue amount. But if your total revenue is 100,000 and you make a mistake or an error of 10,000, it means it's significant, it's material enough considering the total revenue. Right? So if material errors discovered will be dealt with in the same way as the policy changes that we talked about. This results in a restatement of the opening balance of retained earnings and any comparatives to reflect the amounts that would have been reported yet the error never occurred. So for example, if you realize that when you accounted for your rentals, instead of 100,000 for rentals, you actually put your rental figure as 10,000, which means you understated your rentals by 90,000 and overstated your profits by 90,000. So we're saying if you then overstated your profits last year by 90,000, it means your retained earnings was actually also wrong because it included a profit that was overstated by 90,000. That's why we are saying the rules are the same as changes in accounting policy, because you are going to then correct retrospectively. You start by correcting the error last year and then correct the opening balance in the current year because it will be affected by whatever amount you opened your trial balance. So that's basically how we treat errors. So in other words, errors you apply retrospectively just the same way you apply accounting policies. Accounting estimates are the only ones where you use the prospective group. Right, so let's look at a few examples together. So which of the following is a change in accounting policy under IAS 8? So the first one, classifying commission earned as revenue in the statement of profit or loss, having previously classified it as other operating income. So what is changing there is the classification. The amount is not changing. Remember, we said accounting estimates at the end of the day must result in a certain figure that needs to be changed. What we are changing here is we are putting commission under revenue instead of putting it under other operating income. So if we were to do it this year and we want to compare this year and the previous year, the fact that we've actually changed it means revenue is no longer comparable, operating income is also no longer comparable. So any change in the classification, as we've discussed, is an accounting policy. So that's an example of an accounting policy. Then changing the value of a subsidiary's inventory in line with the group policy for inventory valuation when preparing consolidated financial statements. I know we've not looked at consolidation financial statements, but I want you to just think about it for a minute. Okay, so you then realize here that what we are changing is the value of a subsidiary's inventory so that it's in line with that of the parent company. So we are going to discuss this when we are consolidating, but consolidating simply means we are taking our inventory and the subsidiary's inventory and we are adding them together as if we're one operating company. So what we are changing there is the value of the subsidiary's inventory so that it reflects the policy of the parent, but we are not changing the accounting policy of the subsidiary. Sorry, we are not changing the accounting policy of the subsidiary. What we are changing is the amount of the value, which means we are simply changing the accounting estimate from the subsidiary's perspective, not necessarily changing the group policy. I'm sure this will become clearer when we are talking about how we consolidate inventory when we meet on Monday. So this is actually a reflection of a change in accounting estimate as opposed to an accounting policy. Then revising the remaining useful life of a depreciable asset. we have already made a decision that we are going to depreciate the asset, which is the policy part of it. What we are simply changing is the useful life, which means the amount of depreciation is the one that is going to change. But the fact that we are depreciating is not changing. So this is basically a change in accounting estimate as opposed to in accounting policy. Okay, so that's basically IS 8. So I have also put 3 more questions. Please take your time to go through them, and then we can talk about them. You can answer them at your own time. So that's basically changes in accounting policies. Right. So these are the 3 standards that I wanted us to look at today. Then when we meet on Monday, we are going to start with consolidation. So I'm told you have a guest lecture. I'm not sure when it's going to happen. So the guys that are going to be taking you through will cover the conceptual framework and income taxes. That's why I've deliberately left those 2 so that you can cover them in the guest lecture. Then I'm going to cover as much as I can in terms of consolidation when we meet on Monday. Then I'm sure 1 or so more lecture enough for us to cover the content, because I want us to dedicate 2 sessions to doing past exam questions so that you can perhaps get a picture of what is expected of you from an answering perspective. I believe that's more important than the content that you can actually read on your own. So do 2 sessions to just look at questions, how you are supposed to answer them, and then you can help each other from there. So I don't know if you have any questions. Okay, I will take your silence to mean that you don't have any questions. So I'm going to end this session. Then I'm going to share with you my YouTube page, because I'm going to upload it there. Then we can always watch it from there. Because I don't think it will be, I think it will be too big to send on WhatsApp. So you can always download it from YouTube if you can. All right, so that's the end of our session. We will see each other on Monday. Okay, bye-bye, guys.